So, as a hedge fund manager, I'm often asked which are the stocks to buy now. So I thought, given it's 2021, I'll do a quick run through. I'm going to simplify things for you. I'm going to show you the NASDAQ 100 as a focal point. Okay, you can see it there. It's the NASDAQ 100. We're going to focus on for this just to narrow things down. Now, let me tell you all the criteria we're going to look through for the 100 tech companies here. Now, even if you're British, this is relevant to you, okay, because you can put this in your SIP or your ISA. Now, I'm only giving this for educational purposes. It's not investment advice because I don't know your personal circumstances. So remember, it's investment advice. And there's certain rules I want you to abide by to keep things simple. Those rules are 12, 15, 25, and 40. What are those numbers? 12 means I want you to hold before reviewing for 12 months, not for one day, not for 1 week, but for 12 months, because that's the basis on which these fundamentals we're going to examine, and I've not shown all the fundamentals I look at because I've simplified things, they operate. That's 12 months. 15 is the maximum number of stocks you're going to have. Now, if we don't find them in the NASDAQ 100, we'll have to expand out, but 15 is the maximum number. Why? Because you have more than that. Statistics shows that you'll be over diversified. You won't get the full benefits of picking a good stock, and if you have too few, you'll have taken too much risk and put too many of your eggs in one basket. Okay, so that's the 12 and that's the 15. What's the 25? If any of the individual stocks drops more than 25% from the highest point at which you bought it, you get out. What does that do? Well, it caps your losses at 25%, but it also means that should you get a whopping 100%, 200% return on something and it drops back 25%, you're protecting your profits as well. It's a simple rule. It'll do for now. 40 is the percentage return annually that I am targeting. Doesn't mean I'll get it. In a way, it's irrelevant, but it's what I'm targeting. So how do I target it? Let's get started and let's look at these individual stocks. First of all, we know research shows that a lower valued company is going to outperform one which is higher valued, all other things being equal. We know a company with stronger growth, sales growth, profits growth is going to outperform a company with lower growth, okay? So those are two factors we filter in. I weigh them. I also examine not just valuation, and if you're interested, yes, it does come down to price to book ratio, price to earnings ratios. The exact formulas don't matter, they're proprietary anyway, but it's the principle. I'm also looking at dividend yields. Why do I look at yields? Because we know companies with higher yields tend to perform, all other things being equal, than those with lower yields, okay? But just because a company isn't paying dividends doesn't mean it'll be totally penalized. It'll go into the score and it'll get a little bit of a points knock for that. Similarly, those which are too expensive in this list will get a bit of a knock. It doesn't mean we exclude them just because they're expensive, because we know expensive companies can rise. We want profit growth, which is what the PEG measures. We want momentum because we know, as well as valuation growth income, which is dividend yields, momentum is a good, important driver of stock performance. These are not the only things. Cash flow, which is what Croce measures. It's a measure used by Goldman Sachs Asset Management, and it was invented by Deutsche Bank. Companies with greater cash flow tend to do better than those with lower cash flows. So, for instance, I do not like companies with negative cash flow, and I want the cash flow number to be as high as possible, and preferably amongst the peers that we're looking at, I want it certainly to be in the top 25%. So I'm filtering across these and other factors. But let's look at these slides. Let's look at each of these stocks individually as well, okay? Because those aren't my picks. Those are just some of the rankings. Now, Broadcom, yes, valuation, growth, technicals, all very good, strong upward trend. The problem is when I look at the monthly charts, which is what we're going to look at because we're looking at a 12-month holding, it's overbought. How do we know this? We know this based on looking at not just the factors that I already mentioned, but also this little indicator, which is a measure of momentum of a company. So Broadcom, I'm afraid, whilst it does tick a lot of our boxes, it's probably a little bit too overbought. Doesn't mean it won't shoot up. It may well do, but I'm a bit worried. On the other hand, Alexion Pharmaceuticals at an 8 and has been going a downward trend for a long time, which is not something I particularly like, by the way, but has started moving upwards. The only thing I'd say about this one is in the past, it has tended to be at these levels and then drop back down. So it's a little bit riskier, but at least valuation, growth, income, and also the other factors that I already mentioned in terms of cash flow, they all look solid. Okay, so let's go through some more. Overbought, Apple. However, Apple happens to be one of my core holdings. I know that even if Apple goes through a phase where all it does is fall down, 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 I don't mind. I'm still going to keep hold of it. So Apple, it's not an issue for me. I do not mind having that. My other 5 quality core holdings, as well as Apple, are Alphabet, Facebook, Microsoft is in there as well as and Amazon. Okay, so in some way they get a pass for being a bit overbought because at least I know my money's safe. Applied Materials, bit of a problem again. It's a bit overbought. You've seen what happens if it's overbought. Look at that. Look what happens. Okay, it can go sideways after a massive rally and then it can fall. So I'm going to leave that well alone. Overbought. What about this? Well, this one, Corey Dr. Pepper, doesn't have enough data, I'm afraid. So I'm going to leave that alone for that reason. KLNA, Telenor. Again, I know overbought companies can continue rising as some of these have. So if you're willing to take more risk, ignore this last part where I'm talking about overbought. I told you Microsoft's one of my quality companies, so I don't mind if it's overbought. NetEase, again, overbought. Look at that. It's so high up there. However, if you're willing to take higher risk, because valuation, growth, income, momentum, cash flow are all boxes which are ticked, that's fine if you're willing to take that extra bit of risk. Packard, not a nice smooth upward trend and overbought, so I'm going to leave that one for now. Okay, what about this one? PepsiCo, you've all heard of it. Well, there we go. I think that's relatively safe. I don't think it's going to give me a massive return. I don't think it's going to go up 40%, but in terms of balancing safety with returns and a big brand name, often surprises people that it's in the NASDAQ 100 because they think only tech companies are. You can see that actually it's been at these levels before and does steadily grind up. So yeah, sort of lower return, but not too bad. Adobe, bit overboard again, and it's a 7. That's fine. I only go for 7s, 8s, and 9s on my value, growth, income, momentum. Okay, so it's not one which I'm terribly excited about, I'm afraid. So, if you want more excitement, leave it out. This one, a little bit better, because again, there's some more room to go up. Probably not loads, but at least a bit of room to go up from where it's been in terms of aligned technology. Now you might say, well, Alpesh, that's rubbish. You're not throwing names at us. You're going through the NASDAQ 100 of the top ones, and you're still not coming up with some great names. Yeah, because if it's not there, it's not there, and that's the whole point. Similarly, ANSYS, you might say, well, Alpesh, look, nice upward trend. Yes, I know it's overbought, but look at the valuation, growth, income, momentum, and all the other criteria. So yes, if you relax one of your criteria, such as the MACD, the moving average, the overboughtness, then you're taking a bit more risk. But you might be willing to do that. If you are, then ANSYS fits your bill. Do you see how it's evaluated? Now this one's a bit better, automatic data processing, because look, there's a bit more room here for it to continue upwards. And 7, 8, 9. So that sort of ticks the box a lot more. Booking, similarly. Now you might say, well, no, I'm not going to do booking. Alpesh, have you read the news? There's a virus going wrong. And so on that basis, you might overrule your own system and say, no, don't want to do it for that reason. That's where humans come in. Okay, Cadence Design Systems, again, overbought. If you're willing to take the extra risk, then that one's fine because the other criteria and boxes are ticked. CDW, similar kind of story as well, in that, yes, it's got room to go up, so it's fine. And you might think, yeah, this is going to steadily go up. I am a shareholder, by the way, in CDW. 7 value growth income rating. What about this one? It seems to be going sideways for a hell of a number of years. So I'm just going to stay clear of that because I'd rather if it was something going on a nice upward trend. Cognizant, got some room to go up. As you can see there, and it's a 7 on a value, growth, income, and croaky and all the other factors. Now, of course, I'm doing a very quick simplified version of this. Here's another one, Copart. Okay, nice smooth upward trend up there, a bit more room to go up, a little bit of a risk because it's overbought. So, balance that into the factor. Like I said, I'm doing this in a relatively rush way as an educational tool to explain to you. Electronic Arts, upward. Still got some room. It could go up. It's had some good solid upward trends. It could go, I can see it going higher on evaluation, growth, income, and all the other factors that we showed earlier. Because remember the other factors we showed there. Okay, you can see it over there. Now I'm not going to go through every single one of these. Let me do the rest of them relatively quickly. Overbought, high risk. Okay, but meets the other criteria. Overbought, high risk, but meets the other criteria. What about this one? A bit more room to go, so slightly less risky, meets the other criteria, so that's good. This one, overbought, I am a shareholder, meets the other criteria, so slightly higher risk. Overbought, slightly higher risk, meets the other criteria. All right, this one, Netflix, you've all heard of. Bit more room, a little bit overbought, higher risk, meets the other criteria. Okay, and intuitively you might even have known that already. O'Reilly Automotive, meets the other criteria, a bit of room to go up, so not too bad actually. PayPal, I happen to be a shareholder, overbought, so a bit risky, but meets the other criteria. Right, Ross Stores. This now does get me a bit more excited, because look at that, it's got a bit more room to move up. So yes, that does get me excited. Synopsis, or as the Americans say, synopsis. Yeah, meets the other criteria, but overbought, so slightly higher risk. T-Mobile US. Meets the other criteria, slightly higher risk. Now, on this basis, you might now turn around and say, Alpesh, you're just giving me all of the names now. Narrow it down even more. Well, I have. The ones which aren't the higher risk ones might be the ones you want to focus on. And I haven't just named them all, because as you'll see here, and VeriSign was the last of the 7s, we're not going to go with any of these other ones. Now, you might say, well, wait a minute, Alpesh, you're missing out on some of the others. What about eBay? What about Qualcomm? What about these? Well, unfortunately, they're not meeting enough of my other criteria. And they might skyrocket, but I've got enough to be playing with, and that's the criteria. Okay, I've got enough to be playing with. Hopefully that was a very quick whiz-bang overview of what we do as a hedge fund manager. And if you want to learn some more, don't forget to click like and subscribe and all of that stuff. Look at the links in the description as well to see some of the free education resources that I give, and also my free Telegram channel where I give you insights into what we do and lift the lid on what professional hedge fund managers do, or one of the things that they do. And I've summarized it in 12 minutes, which doesn't do it justice. So please bear that in mind, okay?